If you've just opened your first brokerage account or smartphone online account, somewhere where you have to put in your own orders, then you will come across a trading screen with different order types and also different timescales as well. So in this one, I just want to go over all of those different types, what exactly they mean, the benefits of using them, some of the drawbacks as well. So that's what this one is about. But first, please just give the video a thumbs up. It does help the video and the channel, and subscribe for way more like this. And let's get started with the first one. A market order is an order that absolutely guarantees execution, but does not guarantee the price. So you have absolutely no control of the price when you put in a market order, but you have control over the volume, so how many shares you actually want to buy. Be very careful when using market orders because they have a very clear and obvious downside, which is if you are not limiting the price at which you're buying a stock, then you could pay absolutely anything for it. And from experience trading, being a stockbroker, trading bigger orders, I know that market orders really, you can get taken to the cleaners in terms of price. If you put in any sizable amount of volume, so you're buying a lot of shares at market, you are probably going to be paying up for your shares. So the offer price, that's what you'll be paying if you are buying shares at market, is at a certain level, let's say 100. And if your volume is bigger than the volume on the offer or on the ask, then you'll start going to the next level and you'll just be paying up for the more shares that you buy. So it's really important to know that when you trade a market order, you're probably going to be paying a higher price than you could possibly. This also depends on the amount of shares that you're trading. If you're trading really small amounts, it might not matter, but you have no control over the price that you pay. The thing is, when it comes to the stock market, if you're just putting in an order yourself on one of these trading apps or online, you really don't know what the true market is in that stock. And there are so many people trading that stock, especially if you're trading big stocks. There are computer systems that really can try and read the market. And if you put in a big market order, then they're just gonna trade around you. They know exactly what's coming into the market. What is on the bid and offer is only a small amount of what people are actually trading in the market. And so really these computer systems and people are waiting for market orders to come in so they can basically just rip you off from your trade. So this is a really big downside of market orders, is you might get ripped off and pay more for your shares than you need to. If you have an order for 100,000 shares, for example, and the current offer price is $100, but the volume on the offer is only 20,000 shares, you have 100,000 shares to buy. What's going to happen? Well, you're going to lift that offer at 100, that's 20,000 shares, you have 80,000 shares left. You have to execute that order. What's going to happen? Well, you're going to go to the next offer, which may be 101. If there's only 20,000 shares there, then you're going to go to the next offer, which may be 102. Suddenly, the average price that you're paying is going up and up and up. And what you should know is that what is on the offer isn't the whole order. There may be many orders behind that. And so being quick, trying to get your order done, may just mean that you just get ripped off. So definitely market orders, good in certain conditions, but most of the time, maybe if you're trading in any big volume, you may want to try and actually have a limit order, which is the next one. As the name suggests, your order is limited by the price that you put in. So with a market order, you just put the amount of shares that you want to buy and that's it. With a limit order, you have to put in the amount of shares that you want to buy and then the maximum price that you are willing to pay. Also, if you're selling shares, it works for the same, but I'll just keep it buying just to make it simple. So if you want to buy 100,000 shares and your limit price is $99, the current offer is $100, then obviously you're not going to be trading at that level. You can put in your bid. So you want to buy those shares at 99. Currently, no shares are being offered at 99, so your order will not go through. Your order will actually join the bid, so your order will be in the market at 99. If there are sellers that are willing to sell you their stock at 99, you will be filled, your order will go through, but as it stands, the market is above your price level, nothing will happen, but your order is there. Of course, you cannot put in a limit price that is above the market. That doesn't make any sense. If your limit price is 101, The current market price is $100, then obviously you're just going to trade at 100 and that gets you a better deal. Nothing really more to say about limit orders, very simple, but let's go on to a stop loss. This is something that you can do on some trading apps, depending on which service you're using, but a stop loss, as the name suggests, is an order that you can put into your brokerage account that will automatically trade for you and stop any losses in your trade. So obviously you're going to need stock in your account already. So let's say you've bought into a stock at a $100 price. You can set a stop loss at $90. So you can tell the system basically, hey, I bought these shares at $100, and if the price moves against me, the trade moves against me, the stock price starts coming down, I want to limit my losses. I want a stop loss at $90. So if the share price does come down to $90, the system will automatically trade for you and sell your position at that price. So you can know when you're trading that you only have a certain amount of risk. You can only lose so much because you have that order in there already. Obviously, you can't watch your trade all the time. You might have more trades. And so this is just an automatic way of just limiting some of the risk in your trades. When a stop loss is triggered, it turns into a market order. So that's really important to know. If the price does fall to that level, it will just trade at market. So there are things called stop limit orders as well, which I guess you can work out will trade out of your position if it reaches a certain level, but only that price. So you can either have a stop loss, which is a market order at that level, or a stop limit loss, which will sell out, but only at a certain level. So that may be an option that will be in your brokerage account. Trailing stop losses are slightly different and they can actually move around, although there is a base. So you set the base. So again, the example I've used, you buy stock at 100 and you say, I want a trailing stop loss of $10. So the lowest level, if you bought in at 100, the lowest level would be 90. So if you buy in at 100 and then the market moves against you straight away. So as soon as you buy in, it just starts going down and it reaches 90, it will stop you out at 90, automatically trade out of your position for you. But if you buy in at 100, and then the price moves up, let's say to 110, then the trailing stop loss will move up with it. It is just below your level all the time, 10 difference, because you stopped it at a $10 difference. So you move up to 110, the stop loss will move up to 100. Then if the price does start moving down, like 109 or 108, that stop loss will not move. It essentially follows up, but does not follow down. So if you keep moving down and down and down, and it gets to 100, then it will stop you out at 100, which is where you entered the position. If you bought in at 100 and the price moves up to 120, and you have a trailing stop loss at $10, it moves down to 110, then it will stop you out at 110, and well, you've made $10 on the trade. They're really the basics when it comes to setting prices. So the limits that you want to buy in at, or how much volume you want to use, or stop losses. But there are also time scales, and this is really important as well, especially when you're trading. Things can change, orders can change. So there are different time scales that you can put in when you are trading. So the first is fill or kill. Self-explanatory really. You can either fill your entire order as is, or if you cannot fill the entire thing at once, straight away, immediately, then the entire order will be cancelled off the book, and you can maybe go again with some different parameters, or just do the same thing again to see if the market's changed. If you are trading on a platform and you're trading in blue chip stocks, this type of thing obviously is not going to be an issue. The amount of stock that's traded is absolutely massive, and there's going to be no real chance of you not filling your order. So definitely fill or kill. It's useful in some instances and not in others. A good till cancelled order is one that you put into the system. Obviously has to be a limit order. It can't be a market order, because then you would just go and trade it. So definitely with the GTC order, good till cancelled, you put in your limit price, you put in the amount of shares that you want to buy, and then you call it GTC, good till cancelled, which means that will stay in the system. And as soon as the parameters are met, the price is met, then it will trade for you. So that will just stay in there forever until you physically go in there and either delete the order, remove it, or whatever. Good until you cancel it. good for the day, pretty self-explanatory. Your order, and it has to be a limit order, that will be in there for the day, and then when the market closes for that day, it will just cancel out of the system, automatically delete if it hasn't been fulfilled. So what are the most important order types? It really is limit order. You have to set the price that you are willing to trade at. That's really the most important. It's the basic fundamental thing. What price are you willing to trade at? How much volume? How many shares are you willing to buy? And that's pretty much the basic one. A limit order is a good way for you to say, I'm comfortable at getting in at this price. And you know, with blue chip stocks, they do move around quite a lot throughout a trading session. So if you're on a smartphone trading app, I would always suggest the limit order because prices will move and you really don't see a lot of what the real market is on those trading apps. There's not a lot of information about volumes or specific prices really compared to what professional brokers would be looking at. So I would recommend a limit order really most of the time if you're trading on a smartphone app or a trading platform, just so you know you're not getting ripped off too much with a market order. But hopefully that was helpful to explain order types and also some of the time scales. If it was, please give a thumbs up on the video, subscribe for more like this, and I'll see you in the next one.